Welcome to the Level 1 Economics Summary video series. This video is a summary of the reading on currency exchange rates. First, some basic definitions. Let's say we have this exchange rate, 1.4 USD per euro. In this exchange rate convention, we refer to the numerator. So this number 1.4 USD. So USD is the price currency. Euro, of which we have 1 unit, is the base currency. So what this is saying is 1.4 USD will be equal to 1 euro. This is a direct quote for a US based investor. A US based investor thinks in terms of dollars. So he wants to know how much 1 euro is worth in dollars. So for a US investor, this is a direct quote. For a euro-based investor, this is an indirect quote. Nominal versus real exchange rates. A nominal exchange rate is the quoted rate at any point in time. So this, for example, is a nominal exchange rate. When you look at exchange rates in the financial press, those are all nominal exchange rates. The real exchange rate is the nominal exchange rate adjusted for inflation in each country compared to a base period. So specifically the formula that you need to remember is this. The real exchange rate, again quoting convention is price currency over base currency, is equal to spot exchange rate quoted as price over base times the price level in the base currency over price level in the price currency. Spot market versus forward market. The spot exchange rate is the currency exchange rate for either immediate delivery or T+2. The forward exchange rate is a currency exchange rate for an exchange to be done in the future. A forward contract is an agreement to exchange specific amount of one currency for a specific amount of another on a future date. Participants in the FX markets. In terms of daily transactions, currency is the largest market. It is much larger than your bond market, much larger than the stock market, and so on. Within currency, FX swaps are the largest, followed by the spot market. Transactions related to speculation and hedging far exceed transactions related to international trade. In terms of hedgers and speculators, hedgers have an existing foreign exchange risk which they want to reduce or eliminate. Speculators enter into transactions that increase their foreign exchange risk with the expectation of earning a profit. In terms of buy-side versus sell-side participants are market makers and large multinational banks. Buy-side entities are corporations, investment fund managers, hedge fund managers, investors, governments, and central banks. Some quick calculations. Let's say that you have the USD-Euro pair and that is quoted at 1.4160 and then goes down to 1.4. When the number goes down, that means that the base currency has depreciated. If the base currency has depreciated, that means that the price currency has appreciated. So remember, up and down is with reference to the base currency. In this particular scenario, we say that the base currency has depreciated by 1.13%. If we take the reciprocal, then we will notice that the dollar has actually appreciated by 1.46%. Cross rates. The computations for cross rates are a simple case of algebraic manipulation wherein the quotes should be set up in a way that the common currency cancels out. Let's say you are given the following spot rates in the interbank market, and these spot rates are the Pakistan rupee, PKR, to the Indian rupee. That spot rate is 1.78. And you are also given PKR to BDT, which is the Bangladesh Taka. So that is 1.22. Given these rates, can you find the Indian rupee to Bangladesh Taka, which is implied by the given rates? If you find this out, that is called the implied cross rate. So what you can say is the following. The INR to BDT is equal to INR over PKR times PKR over BDT. The PKR will cancel out and you will be left with INR to BDT. So are you given the INR to PKR? You are given the PKR to INR. So what you have to do is find the reciprocal, which is this 1 over 1.78, and multiply that by PKR over BDT, which is given, that's 1.22. You do that and you come up with the INR to BDT of 0.685. That is the cross rate. Forward exchange rates and forward quotes. Let's say your spot rate is 1.4. Again, this is USD over Euro. And you are told that the forward quote is spot plus 200 points. That would mean that the forward rate is 1.4 plus the 200 points, and that gives you 1.4200. To convert the points to decimal, simply divide by 10,000. So 200 over 10,000 is 0.02. Just to make this clear, the point is the last digit on the spot rate quote. So if your spot rate quote has 4 decimal places, then the last decimal place is the point. If you are given 1.4000 and I say that the quote has gone up by 2 points, that means that the spot rate is 1.4002. In a currency pair such as yen to dollar, where you have 100.50, for example, 2 decimal places, then the point would be the second decimal place. But most currencies have 4 decimal places, so by and large, we will see points such as those shown in this example. We can also express the forward rate as a percentage above or below the spot rate. If the forward rate is greater than the spot rate, then we say that the base currency is trading at a forward premium. If the forward rate is less than the spot rate, then the base currency is trading at a forward discount. And automatically, if the forward currency is trading, and automatically, if the base currency is trading at a forward premium, that implies that the price currency is trading at a forward discount. You need to know the link between the forward rate and the spot rate, and this is the formula. I like to always express the exchange rates as price currency over base currency. So forward rate is equal to the spot rate into 1 plus interest rate in the price currency divided by 1 plus interest rate in the base currency. And remember the base in the base rule, which means that the base currency is in the base, which in this case is the denominator. The numbers that I have shown here, the interest rates, are de-annualized interest rates. If you are actually given the annualized interest rates and then you are told that this is a 6-month forward contract, then you would simply take the annualized and de-annualize by multiplying by 180 over 360. An approximate version of the formula is shown right here. The difference between the forward rate and the spot rate is approximately equal to the interest rate differential between the price currency and the base currency. Foreign exchange regimes. Foreign exchange regimes for countries that do not have their own currency. We have 2 possible scenarios. One is formal dollarization, where a country simply adopts the currency of another country, typically the dollar, or you might have a monetary union such as the Eurozone, where all countries in the Eurozone have the euro as their currency. Then the other exchange rates where countries have their own currency are shown right here. A currency board system is as close as it gets to a fixed rate system. So there is an explicit legislative commitment to exchange domestic currency for a specified foreign currency at a fixed exchange rate. Fixed parity means a country pegs its currency within margins of 1% versus another country. With fixed parity, there isn't a legislative commitment. Target zone is like fixed parity but wider bands, which gives monetary authority more flexibility. In a crawling peg, the exchange rate is adjusted periodically, typically to adjust for higher inflation versus the currency used in the peg. A managed float is what many countries have. Here, the monetary authority attempts to influence the exchange rate in response to specific indicators such as balance of payments, inflation rates, or unemployment. without any specific target exchange rate. And finally, you have an independent float where the exchange rate is entirely market driven. So dollar euro, for example, would be an example of an independent float. The final slide here, exchange rates and trade deficit. The effect of a depreciation of the domestic currency on a country's trade can be analyzed using either the elasticities approach or the absorption approach. So elasticities approach first. For a depreciation of the domestic currency to reduce an existing trade deficit, the elasticities of export and import demand must meet the Marshall-Lerner condition, which says the following. The weight of exports relative to overall trade times the elasticity of exports plus the weight of imports relative to overall trade times elasticity of import minus 1 must be greater than 0. If this is the case, then a devaluation of the currency will reduce the trade deficit. According to the absorption approach, the national income must increase relative to national expenditure in order to decrease the trade deficit. In other words, national savings must increase relative to domestic investment in order to decrease a trade deficit. And the final point is the J-curve effect. In the short run, existing contracts make exports and imports relatively inelastic, and this connects with elasticity, where often elasticity tends to be less. So generally, we are more inelastic in the short run, and with longer time periods, we tend to be more elastic. The same applies in the context of global trade. Therefore, currency depreciation initially leads to a larger trade deficit, but in the long run, elasticities increase and the currency depreciation leads to a trade deficit reduction. All right, so that is the end of the economics review, a huge segment. And obviously what I expect you to do is practice questions. Try to do the 2012 and 2013 mock exams. Try to do all the questions from the curriculum. And we've also made videos on all the economics examples. At the very least, go over all the MCQ examples in the curriculum. They are very useful. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.